thank you all for joining us today. We've spent the last 2 years getting Airlines ready for this moment. We've finally reached the inflection point as we transition from pandemic to endemic, and demand is stronger than I've ever seen in my career, and that's even before business travel fully recovers, though it continues to accelerate at a rapid pace, and before international, especially Asia, fully recovers. We expect that will lead to the best TRASM and highest quarterly revenue in our history in 2Q, and despite the higher fuel prices, we're forecasting approximately a 10% operating margin this quarter. The rapid acceleration we're seeing in business and long haul as they move to catch up to still strong domestic leisure demand gives us great confidence in the future outlook. But I now think the domestic market is also going to be robust. I think every single person listening to this call that has a spreadsheet with a forecast of industry capacity in the years to come is wrong, and probably wrong by a lot. The pilot shortage for the industry is real, and most airlines are simply not going to be able to realize their capacity plans because there simply aren't enough pilots, at least not for the next 5+ years. Given the work that we've done on our brand and customer experience, United, of course, isn't having any problems hiring pilots. We are always top tier for pilot pay, have a ton of growth opportunities for pilots coming soon, and we have, by far, the largest number of higher paying wide-body flights and positions. And looking forward, when United alone is ramping up to hire about 200 pilots per month, that situation is only going to get worse. This is not a temporary issue. Because of that, I now think the domestic TRASM environment is going to be much stronger in the years to come than we previously thought, because supply is going to be constrained by lack of pilots. You put all that together, and we feel very bullish. The last 2 years have obviously taught us that macro events can quickly change our outlook. But our 2Q base expectation has us just 350 basis points shy of our 2019 adjusted operating margin, and we expect that our plans to bring the 777s back, continue to gradually add back capacity, and grow gauge are going to drive CASM-ex down significantly from their still COVID-elevated levels. We're also confident that the robust business travel recovery still has a lot of room to run, and we anticipate improvement in long-haul Asia that is not yet reflected in our revenue results. That means we're more confident than ever that we'll meet or exceed our approximately 9% adjusted pre-tax margin target for next year, and particularly with our view of the supply dynamics in both domestic and international, getting to at least our 14% target for 2026 seems pretty straightforward.
We continue to make progress towards our hiring needs as we look towards United Next. This January, we celebrated opening our Aviate Academy in Arizona and welcomed the next generation of pilots to the United family. This flight training school is the first of its kind, and we believe it will help to maintain a pipeline of qualified pilot candidates for United as our industry looks to combat the pilot shortage. We are particularly proud of providing the opportunity for aspiring pilots from diverse backgrounds to study and train at the Aviate Academy. Over the next 8 years, we plan to train 5,000 new pilots at Aviate, with the goal of at least half being women or people of color. We are also continuing our path as an industry leader in sustainability. United remains the only airline that is committed to becoming 100% green by reducing 100% of our greenhouse gas emissions by 2050 without relying on traditional carbon offsets.
I normally start each earnings call with an update on the previous quarter's revenue performance. However, today it just seems more appropriate to start off with our Q2 outlook. We've clearly passed a major inflection point with demand and yields and have a confident view of the future. Q2 TRASM is expected to be up 17% versus Q2 of 19, a step change increase from our Q1 TRASM of down 3%. We're confident United is currently set up to achieve record TRASM and revenue results in the second quarter. The revenue inflection point started in March with TRASM up 9% versus 2019. Revenue momentum is coming from just about every category, including higher yields, ancillary seat sales, strong premium leisure demand, mileage plus, rebound in business demand, and a record-setting season across the Atlantic this summer. Even parts of Asia are rebounding. We often have talked about United's high exposure to business traffic and the resultant headwind the pandemic caused. United produced industry-leading TRASM results during most of the pandemic, even when faced with this substantial headwind. Now with business traffic rapidly recovering, I expect United to have a tailwind versus more leisure-focused carriers, a fact I think we can see in our Q2 guidance. Business revenue for the last few weeks has been down about 30%, with the last week now down only 20% versus the same period in 2019. Large corporations are now returning to travel at a faster rate than small. This is really important to United's Q2 outlook. As of last week, business yields are now close to up 10% ahead of 2019. Given these revenue trends, business TRASM contribution is expected to be approximately 100% of 2019 levels soon. After all the debates about the return of business traffic, it's nice to see this important milestone in sight, even with many businesses not fully back in the office. Demand for business, leisure, and cargo traffic continues to be strong even as we pass on 100% of the fuel price increase versus 19. United's bookings for Q2 are strong, and we believe we still have sufficient rooms to sell peak period travel at robust yields. Yield momentum is generally very strong across most of our regions. Across the Atlantic, we expect to grow by 25% this summer, becoming the largest airline in that region for the first time. We also see momentum in Australia and many other countries that have opened their borders and expect further gains when the inbound U.S. testing requirements are relaxed. In Q2, we expect to operate Pacific capacity down about 65% versus 19, and Latin American capacity up 9% versus 19. Cargo continues to produce strong results with revenues up 26% in Q1 of 2022 versus 2021, and up 119% versus 2019. Ocean shipping and supply chain disruptions continue to boost our revenue outlook for cargo.
And from Raymond James, we have Savi Syth. Please go ahead.
I was just curious on the peak versus off-peak performance, because that was a trend that, saw really strong peaks and maybe off-peaks not as strong, and, how you're thinking about as we exit, the peak summer travel period.
I think we're going to see, I think one of the most important things I said earlier was the RASM from business travel as actually approaching and will be 100% of 2019. So we now view business traffic as, almost fully returned, particularly given the level of capacity that we're often in the marketplace. As we exit the summer, we will rely more on business traffic, and we have a high degree of confidence that that's just going to be perfectly fine, and we're going to continue to accelerate as we go through the fourth quarter, with October being an incredibly strong business month, given where we see business trends today. So we're very bullish on business, and again, it's nice to see after all of the debates about how much would come back and when it would come back, that we are approaching 100% from a revenue recovery, and we have a long way to go because the offices have not fully returned yet. Everybody's still not in their office. So we think there's actually more upside there than maybe a lot of people thought just a few months ago.
From Goldman Sachs, we have Catherine O'Brien. Please go ahead.
It sounds like from your comments that both domestic and some international markets in transatlantic and LATAM are running well ahead of 2019 at the same time for this summer. I guess, do you see that slowing at any point? And I guess if you do, how should we think about, long-haul international and corporate pent-up travel, perhaps backfilling that?
The answer to the question is I think there has been a structural change. And I'll go back one step. No one knows for sure, but no one has gotten the pandemic more right than United Airlines from the very beginning. 2 years ago at this time, we weren't just a minority when we said business travel would come back in its entirety. We were a minority of one. Nobody thought that, and now we're going to do it this quarter. And what I think is true, I've certainly personally experienced, I've talked to enough people, is that once people get back traveling, you realize how much you missed it and took it for granted before. It's not pent-up demand. It's a new, higher level of travel. I am going to, I'm certain, or confident at least for the rest of my life, travel more both on personal, for family and vacations and things, and on business. And I think there are a lot of people like that. Losing it for 2 years or for a year, or however long people lost it, we are social creatures. We need to be with each other. We are more productive when we're together at a conference or when we're at dinner with a customer or a client than when we're doing a simple transaction on Zoom and the kids are talking in the background and you're reading your iPhone. It's just not the same. And once you get back traveling, people realize it's even more important. And we got a lot of people. We see it in our corporate accounts. You know, they're kind of flatline doing nothing, then they start traveling and they zoom past where they were. Look, I think that's what's going to happen. You don't have to believe that to buy United Airlines stock or airline stocks, because we're still 16% behind, the trend line of where we were on GDP. I happen to believe that we are going to surpass on a permanent, sustainable basis where we were before. But that's just one guy's opinion.
From Barclays, we have Brandon Oglenski. Please go ahead.
And I guess, what is the outlook on recovery on international business travel demand? Is that ramping up this summer as well, or do you really need to see the testing requirement removed?
Well, it is ramping up. So what I would tell you is in the current quarter, the business cabins are filled more with premium leisure business than traditional corporate business. But corporate business bookings across the Atlantic have largely returned to normal. So as we get into the summer, we do expect, particularly going across the Atlantic, really, decent business traffic relative to 2019, with revenue again at 100% or greater. The same is true in Latin America. It has a smaller business component than Europe. The same is not true for Asia, where we really haven't seen a meaningful recovery in business traffic at this point to the bulk of our Asian network.
Thank you. From SIG, we have Chris Stathoulopoulos. Please go ahead.
On the look forward for business, how much of that is small to mid-size versus corporates? And then what are you seeing on your survey work or other data that you look at with respect to the mix of large corporate, buyers from healthcare, finance, tech, consulting, and the like? Any changes in the mix, frequency, and/or seasonality there? Thank you.
I'll start. The booking curve has changed. It's booking closer in than it did in 2019. Is the first part. All the sectors are returning, some faster than others. Media, transportation, industrial seem to be moving quicker than technology. All that being said, I just want to point out San Francisco, which is a really important market to us. San Francisco, the top 16 metros in the United States, was lagging. It was the number 16th in terms of recovery a month ago. It's now number 8. And so there's been a rapid bounce back in San Francisco. So when I think we get the updated data, I think we're going to see technology is back to flying. It's the only way I can explain what I've seen in the macro numbers for that. So I think we're really kind of bullish on that, and the numbers are supporting that case.
From CNN, we have Chris Isidore. Please go ahead.
Given that the domestic yields are about where they were first quarter of 2019, and that business travel is not yet back up to normal level, do you have any sense as to how the leisure travel yields are compared to that first quarter of 2019? Are they up X percent? Can you give any guidance on that?
They're definitely up. I'm sure all of our customers realize when they pass by a gas station out there that the price of fuel is dramatically higher, and therefore our second largest cost component is dramatically higher at United. So leisure yields, along with business yields, are running ahead. Business yields, I already pointed out, were 10% ahead of 2019 at this point as we look into the second quarter. And leisure yields are above that at this point as we look into the second quarter.